Hi, I'm Stuart Jackson and welcome to this week's Video Insight. As we head into reporting season, I thought I would discuss the impact of the falling Australian dollar on earnings. A number of stocks in the Australian marketplace, such as Amcor, ResMed, Brambles, CSL and James Hardie, have benefited from the Australian dollar having fallen over 30% from its high of just over $1.10 in July 2011 to 75 cents at present. Movements in the Australian dollar impact company earnings in a number of ways. The main two types of impact are through translation and transaction exposure. Translation exposure refers to companies with overseas businesses. These companies will have both revenue and costs denominated in foreign currencies. The impact of a fall in the Australian dollar will generally increase the Australian dollar profit generated by these businesses in line with revenue and costs. Transactions exposure generally refers to companies that have export products from one country to another. As a result, a proportion of the company's costs will be denominated in a different currency to its revenues. This can lead to significant movements in product margins as a result of changes in exchange rates. Resources companies and other exporters like wine producers have high levels of transactional exposure to the Australian dollar. Given changes in the Australian dollar impact both revenue and margin for companies with transactions exposure, the earnings of these companies tend to be far more significantly impacted by exchange rate movements. The impact of the fall in the Australian dollar is far easier to determine for companies with translation exposure than those with transactions exposure. This is because the net benefit for exporters will depend on the competitive landscape in overseas markets. Let's take the wine industry for example. The two largest export markets for Australian wine producers are the US and UK. On the surface, it would appear that the falling Australian dollar should result in a significant uplift in wine producer margins and earnings as the company effectively receives a larger amount of Australian dollars per bottle on the wine they sell in pounds and US dollars. However, a number of other wine exporting countries have also experienced similar or even larger depreciations in their base currencies, such as Chile, Argentina and South Africa. As a result, the competitive position of Australian producers has not improved as much as it would seem on the surface relative to the broader global industry. Some of the benefits from the lower Australian dollar are likely to be competed away. This could lead to results that disappoint the market. This highlights that exposure to overseas earnings and sales is likely to have been positive, but the industry structure and market position of the company remains extremely important in determining how much of the benefit is retained by the company. That's all we have time for today. You can follow us on Facebook and Twitter.